We want to ask the question, will adding crude oil micros to the micro portfolio improve the portfolio? So I want to go over this a little bit in this video, show you the latest on micro crude oil. We have a conservative micro stock index and micro gold portfolio, and this is the performance of that back-tested historical performance: 65.83, 1966.25 drawdown, 27 strategies. What happens if we add the crude oil strategies from the 200K portfolio? So these are already using the E-mini S&P, gold, and NASDAQ strategies from the 200K portfolio. What if we add the crude oil strategy? So that would be 0.1 contracts of this strategy: Esther Canistration 2, 4, 3 A and B, and Cobra Crude conservative and aggressive. And so you see those, how that's added, and then what you see is this goes from 6,400 to 7,900 on the conservative, and the drawdown goes from 1966 to 2057. So you get a big boost in total profit over drawdown by only increasing the max drawdown by about $100 per micro traded. It's in a $711 drawdown currently, and you can see how August, September, October, November can be very consistent. These are micros, keep in mind. You multiply by 10 for the mini. So if you have the all strategy access portfolio or 200K portfolio, you would just be trading the ES, NQ, gold, and crude oil strategies from your all strategy access portfolio. So how does this work on the micros is the question that we're answering. Also, what would it do on the aggressive? So the aggressive micro stock index and micro portfolio is a 37 strategy. So we increased it by 6. So the conservative went from 27 to now 33 strategies. If we take the micro stock index and micro gold aggressive, it goes from 37 to 43 strategies. Let's look at it before we add the crude oil strategies. Now there's a caveat to this that I'm going to explain in a minute. So we're going to delete the crude oil strategies to get a base. Look at the base. 43.12.25 is the max drawdown. 46.45 is the total profit over drawdown. Now I'm going to hit the undo button to add those back because they were in there, and they're added back. You go from 37 to 43 strategies. Boost this by 2,000%. You reduce your drawdown by $800 per contract traded. So also you have to look at the potential gains. Really big July, August, September, October, November last year. Last year was unusual. And then a down December. 2019 was more low volatility, kind of like what we're going through, but very good results for a micro. $11,000 from July, just from August in 2019, which is low volatility year. $11,000 in August per micro through the end of the year, the last 5 months of the year. Now keep in mind, this is using 1/10 of the E-mini contract. So we're multiplying 0.1 or 10% of the E-minis, ES, and NQ, which are E-minis. Also 10% of the full-size gold and crude oil contracts. So we're putting in 0.1, so it's 10% of those. We're doing the back test with 10% of those results with $25 round turn slippage and commission. Now your commission factor is a little higher on the micros, and some of the results might be different on the micros, and crude oil is a new contract. So I don't anticipate that your results will be quite as good. It can be better potentially, because sometimes the ES or a more illiquid contract, for example, may have a swing high. Say for example, crude oil goes up and it has a swing high here. Well, the micro might swing higher, or crude oil might go lower and the micro may go lower, or the micro may not go as low. The crude oil contract may go lower and the micro may not. These swing high and low differences could potentially hit a profit target or on longs or stop losses on shorts where one hits it and the other does not. Same thing in this direction on the downside. So you can get different trades sometimes. I've tried to match these by making data 1 the E-mini or the regular contract, and data 1 the micro, and data 2 the base contract on many of these. But sometimes when you have a set stop loss, it doesn't matter. So you can get different results. This is, once again, this is 10% of these the bigger contracts, and so this is the opportunity. I want to show you the micro crude contracts. So here is micro crude oil on this side, and here is regular crude oil on this side. You see the volume today in the upper corner of TradeStation as of about 3:08 Eastern Time, 17,890. In the regular crude oil contract, 336,000. This contract is 10 times bigger than this contract. So it'd be like 3.3 million micros versus 17,000 micros. So much less liquid contract. You see the volume. The steady state volume is around 50. The steady state volume here, during the day is around, I don't know, between 500 and 1,000. So 10 to 20 times bigger on a contract size that is 10 times larger. So much more liquidity in the regular size contract. This is new, and it could be an issue if you trade it. You might get a lot more slippage. It's kind of an unknown because it's a new contract. You see the first two levels here have decent liquidity, but the past the first 2 or 3 levels, there's less liquidity. So those are some things to consider. If you have the micro stock index and micro portfolio subscription, I am going to work on upgrading these strategies by next week. Should be done by next week, to where we have the micro version of the crude oil strategies, and you're going to receive those. If you don't have a subscription, you can subscribe. The price will increase. The price will increase in August because of these new strategies. So special offer is to get in now before that price goes up for the micro stock index and micro gold portfolios.